All right, my name is Joseph Muslu. I'm currently a college sophomore, or I'll be entering my sophomore year. And I'm studying data science and finance, and I'm giving you guys this presentation on stocks today. All right, let's get started. So a stock, at the very basic level, it's pretty much you're getting part of the company. You're getting an equity stake in the company. So there's stocks for all, pretty much every publicly traded company. Some examples would be Nike, Apple, Microsoft, Facebook. All those companies, they all have publicly traded stocks on the stock markets. And when you buy this company, you own a percentage of it as part of the company's assets and earnings, proportional to the amount of shares or parts of the company that you buy. And this kind of entitles you a share in the company's potential profits if the stock price goes up, or through dividend payments, which I'll get more into later. But you also bear risk because this value of the company can actually go down sometimes. It can go up or down. And these companies, they're traded on something called a stock exchange. And they're the two main ones for the United States are the New York Stock Exchange, the NYSE, and the NASDAQ. These are centralized marketplaces that bring together buyers and sellers and allow efficient trading of these stocks. And these places operate under these government rules and strict rules and oversight to maintain fair and orderly markets. And the people that buy stocks are individuals like you or me, just anyone can buy stocks, or institutions like big banks are also buying lots of stocks. These individuals, people like you or me might invest in stocks because we're trying to use our money to make more money just for personal financial goals or retirements. And institutions generally, it's for their career. They make a lot of money through stocks by pulling in money from their clients who have plenty of money through mutual funds, hedge funds, pension funds, and other professional forms of finance through their clients. And if you want to buy these stocks, well, they can be done through these banks. So Bank of America, Schwab offer all sorts of brokerage services for clients. Or if you also want to buy stocks, what you can do is there's lots of apps on the App Store or online platforms such as Webull and Robinhood that provide you a place to buy and sell your stocks and manage your portfolio. So now getting back into it, money in stocks is made for two things. So when you buy stock, you buy it at a certain price, right? And then this stock price fluctuates by, every couple of minutes generally. And when this price is higher than what you bought it for, you sell it and you keep the difference. Or other way around, you lose money because it lowers in price. And also another thing is dividend income. This is where the company pays money directly to its shareholders. Some companies have this option. And yeah. So that's what a stock is at the basic level. Well, actually, I'll ask if there's any questions on the first slide, I think. Okay. So within the stocks, people generally, they have an idea of what they want to do with them. So I'm going to get into the types of stock investments. And we're going to be taking a look at first, growth stocks. So growth stocks is when people are willing to try to buy a stock with strong earnings growth and future growth potential. They're seeking to make a lot of money on their stock by just having that price really increase and the company just like growing itself. So sometimes what ends up happening with growth stocks is people do pay quite a bit of money because they see the potential in this company. And they hope that this rapid growth in the company will translate into the stock price going up. And this is popular in things such as technology stocks. We see lots of growth, and like biotech, etc. On the other hand, we have value investing, which is a more conservative approach to investing, where people look for stocks that they believe are currently trading below their intrinsic worth, their fair market value, based on looking at the more financial fundamentals of the stock, such as like the earnings, the cash flow, assets, and everything relative to the stock process or price. They buy these undervalued stocks at a discount, so they're seeking to get these good companies on the lower price range, and just hope that the market corrects itself and they sell money on the appreciation in that way, the price appreciation. So within these different types of investments, it's good to have a mixture of both. So it's a core principle of investing that helps manage risk in your portfolio. And it refers to spreading your investments across different types of stocks. And also you can do it with things that aren't stocks, such as bonds. But I'm covering stocks today. Yeah. And within diversification, there's index funds and ETFs. So index fund is actually a bunch of stocks together in one big collection. So when people ask you how the stock market is doing, like they're referring to the index funds, the Dow Jones or the S&P 500, which is a big collection of a bunch of these stocks that are market leaders, and they kind of change, but it's a big collection of stocks. So it's already diversified. Like for example, I know that the Dow Jones has like Apple and Microsoft and all of those big companies in them. And it's just, yeah. And then we have ETF, which is an exchange traded fund. So it's slightly different from the index fund because instead of the market made by the like SEC and the government regulating that, the ETF is made individually by a firm, such as like a bank or something, or a stock manager, and they choose a bunch of stocks that they think are gonna go up. And instead of fluctuating every minute normally, like stocks tend to do, their stock fluctuations in price are calculated once per day. So you kind of see it's a more, I can probably show it later, but it's a less jagged stock line. Yeah. So now we have all this information about stocks, but we don't really know how to measure them. So now I'm going to be taking a look at Apple right here. So at the very basic, right here I have Apple's stock price, and this is how it looks. So over here, what we can see is we kind of see the price, which is on the y-axis. It's going up and down throughout the day. This is the 1 day stock price. You can see how much it's fluctuating, and you can see the range of the price. It starts, the lowest point is there, and the highest is up there around $170. And it also tells you the amount of percentage that's fluctuated in price. And what we can see is if you want to see where the stock price or what the stock price of a company is, you can simply search the company that you're looking at the stock of and search stock price after it. And every stock has a ticker symbol, which is a 4-letter or 3-letter or few letter symbol that just represents the company. For Apple, it is AAPL. And these stock, and through the stock online, you can actually select different time windows to see how the stock is doing over different periods of time. So for the 1 day, the graph looks like this. But through this graph, if we look at the long term, we can actually see that Apple has appreciated 38,000%. So back in the day, if you invested $1,000 in Apple, you would have turned that $1,000 into $385,000 for the value of the stock. So we can really see how picking good stocks can be very important. So now it's so we understand that stocks can make us a lot of money, and we understand that companies have lots of information on them, but there's a lot of information that that isn't the stock price that we need to factor in our investment decisions. So now I'm going to be looking at that. And I'm going to be using something called a stock screener. So this is pretty much an online website or platform that shows you more information about the stock. There's also some information additional on stocks right here, such as market cap, PE ratio, and now I'm going to define everything. So right now I'm going to be using finviz.com, and this is a whole lot of numbers, I know. But we're just going to take this apart little by little, and I'm going to give you probably some of the more important valuations for a stock. So at the very basic, price obviously was the most basic one, the actual stock price. But something else that we need to consider is market cap. This kind of gives us a feel for how large this company is. And the way you calculate market cap right here, if you look at the market cap of Apple, it is $2,614 billion or $2.6 trillion, which is a very large number. And the way you calculate market cap is by multiplying the stock price by the number of shares outstanding. And if we go on this slide, we kind of see shares outstanding at $15 billion or 15 billion shares. So you multiply that by the stock price of $160, and you end up with that number. And then afterwards, we have the income. So the income is the amount of money that the company is actually bringing in after expenses and taxes. And this is very important in a company because we want to make sure that this income is, in good standing and that it's positive, because that means that the company is making money. It's harder to make money on a company if your company itself isn't making money, or the stock price won't go up as much maybe. All of these are different factors. And we got sales now. So sales is the stock price, or no. Sales is the total amount of money that the stock is generating when you're not, before expenses are paid. So this kind of gives us a bigger picture on how much money this company can really bring in, not accounting for expenses and stuff. Because sometimes companies will be able to make a better business model through cutting down on their expenses, so they would be able to tap into their sales to increase their income. Then we have earnings per share, EPS. So EPS is actually calculated by looking at a company's net income. So you get the net income and you divide it by the amount of shares. So what this tells you is pretty much how much each company's share is earning you. So if we're looking at Apple, we're looking at the actual income that an individual stock, if you bought one share of Apple, it would be making you $6 of income, or EPS. So now a very important ratio that very popular ratio that a lot of investors look at is the PE ratio. So this is the price per earnings ratio. So we just look at EPS and we looked at price. So this is simply just price divided by EPS. So a lot of big investors, they really look at this when trying to come up with their investing decisions. Lower generally signals a more, you're paying less per the more earnings. So if you're having a high EPS, this suggests that people are willing to pay more for less earnings. So there's not necessarily a better number for this, but if you're looking at a growth company, the PE ratio is generally expected to be a little bit higher because people are willing to pay more. If I went back on the earlier slides, I was talking about how growth companies, people are willing to pay more for the earnings. So PE ratio is definitely a good thing to factor in if you're trying to do growth versus value investments. And afterwards we have price to sales. This is also pretty simple. This is just price to sales. So if we're looking at the sales of the company, the price divided by the sales, then we end up with that picture. This is also, if you're trying to look at companies maybe making more money by cutting costs, that can be important. I personally like that measurement. I think it gives you a good picture, because a lot of companies that are starting off, what ends up happening is they're not always on their way to profitability right away. So sometimes they have a lot of growth to do in optimization. So you can see this price to sales as a good indicator of where their future might go. Then we have return on equity. Return on equity. So this is pretty much just net income divided by the equity of all the people that own stock. This measures how efficiently, so we looked at the EPS, it's kind of similar because you're measuring how efficiently this company is generating profits from the resources it's getting from its investors. So this is a measure of efficiency of like how well this company is able to leverage its resources. So high is good, and we have a pretty impressive share of return on equity on Apple of 154%. Some return on equities of companies, if they're losing money, can actually be negative because they're not using shareholder money effectively. And then we have the profit margin. This is expressed as a percentage. And this is just how much net income divided by total revenue. And pretty much what profit margin tells you is how much money that the company is making from each of their or from their products, like compared to expenses, like after they pay all the expenses on the company or on their products, like how much percentage they're taking home. So for Apple, like for example, I'm guessing like if you looked at all their products, like if you bought iPad or whatever, or a MacBook or everything, on average, Apple would be taking 26% of that, the price that you paid, like right into their pockets, like after all their expenses. RSI, okay, this is a little bit more of a technical term because this one, but this is also, I think, an important one. This one isn't actually about anything of the company itself, but it's more on the company stock price. This actually measures the direction of the line. So do you remember, if I go back here, we kind of see how this line is kind of going in like this kind of direction. So a higher RSI would indicate a more vertical line. For example, like that. And RSI is generally calculated over like a certain period of time, like 3 months. And this is, you can see that this is going up like a lot. So this would show a higher RSI, and a lower RSI would correlate with a stock kind of going down in price. And we can see that the RSI of Apple currently is 47.32. This is kind of in the middle. A low RSI would be around 30, and then a higher RSI would be over 70. Over 70 shows that the stock is really going in an upward direction. And this is something that's very important to consider if you're looking at growth stocks again, because it's easier to get like a stock on the upswing. And then if you're looking at value investing, probably looking a little bit on a lower RSI because the stock's going to be kind of like down in the gutter before like the market understands its value. And then another thing we got is the analyst recommendation. Yeah. So what's important to consider with the analyst recommendation is there's a lot of these big firms are doing all this research, the big banks, and you can kind of get an idea of what they think about the stock by looking at this recommendation. It goes 1 through 5. 1 is strong buy, 2 is buy, 3 is hold, 4 is sell, 5 is strong sell. And we're seeing Apple right now is 2.11, so that would indicate more in the buy range, or that's what the big banks think, or the big companies like such as BlackRock and these asset management companies, hedge funds, all that, the researchers. And yeah, okay. Yeah. Okay, so now we got, who can we learn about these stocks from? So we looked at all the technical stuff, so obviously finviz.com is a valuable resource for looking at the stock, but also itself, if you want to understand what's going on with the company, it makes sense to look at company news. So you can always look at company press releases through their websites, and that provides a lot of information, or sometimes other firms will do deep dives into their reports. You can always like look at that, just Google information on the company, do some web searching. And obviously another thing is, or the analysts. So these major banks, sometimes they have like reports free to you if you're using their services, where you can actually see their opinions on the stock. So that's always a good way to go. You can kind of see what they have to say about the stocks by using, they're already doing all the technical stuff, so you don't have to do all that necessarily. I mean, it's good to obviously try, look at yourself. And you can see, and then also another thing is famous investors. So this is kind of interesting because they each have their own investing philosophies. And these are people that have made a lot of money in the stock market. So they've kind of amassed like a lot of wisdom and profits over the years. And I have some of their words to share with you. So first we're going to start off with Warren Buffett, who's pictured right there. He owns Berkshire Hathaway, which is a very big company that owns a lot of other companies such as Geico and Sonic and insurance company. Yeah. So he said, be fearful when others are greedy and greedy when others are fearful. This is probably good advice because when the stocks are, you can always catch them on the lower price swings when people are being fearful, and then the other way around with fear. You can always make a lot of money when people are being greedy. So it's good to sell at those times. Also, he says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And he says, our favorite holding period is forever. Now we got Peter Lynch. He says, go for a business that any idiot can run, because sooner or later, any idiot is probably going to run it. I mean, that's good advice. You never know what's going to happen with leadership in a company sometimes. Know what you own and know why you own it. And he also says the real key to making money in stocks is not to get scared out of them, because sometimes we can always be prone to panic selling. We see what's going on with the stocks going up and down. We don't know. So it's good to kind of have a firm footing in your reasoning. And then we got Benjamin Graham. So he says that the intelligent investor is a realist who sells to optimists and buys from pessimists, kind of similar to Warren Buffett's quote. And also he says, the investor's chief problem, even his worst enemy, is himself. And then he says, investors should purchase staid businesses at discounts to an intrinsic value. That pretty much just means just buying like a more boring kind of fundamental, like maybe like an insurance company, realistic, and then just like buy at a low price or a discount. So I think that goes more into the value investing philosophy. And we got John Bogle. He says, time is your friend, impulse is your enemy. He also says, the miracle of compounding returns is overwhelmed by the tyranny of compounding costs. And then he says, stick with basic arithmetic, ownership works. And we got Charlie Munger, who was Buffett's partner. And he says, take one simple idea and take it seriously. And then he says, big profits come from the compound interest and avoiding inactivity and mastering the scorecard. So overall, a lot of these themes kind of go on patience and discipline and buying these quality businesses at fair prices and diversifying, keeping costs low, and just like managing yourself as a person, as an investor. So it's pretty simple, but sometimes powerful advice. Okay, so now we got closing remarks here. So patience and discipline are very important in stocks because you can stocks tend to go up and down, which can make a lot of people panic. But you're not always going to be, the market is always going to be changing. So that's kind of normal. So it's something you kind of have to get used to with stocks, because you want to make sure that you're like not selling earlier than you need to, and you're buying at good times. Like, it's kind of hard to time the market because no one ever really always knows what's going to happen unless you use a lot of math and whatever. Most people aren't going to be doing that, and you don't need to, but you just need to have a solid logical reasoning in why you're making your investment decisions. And then, and also risk management is very important. Some companies are going to be more risky than others. A good way of calculating this or looking at this is I like looking at the market cap of a company, because what ends up happening is these companies with lower market caps, they're more prone to bankruptcy, whereas the higher market cap companies are less prone to bankruptcy because they're always they're more established in their market. It's less likely that a company like Apple just like goes to nothing instead of like some company that you've never heard of. And you want to make sure that your yeah, diversification is also always important. Just making sure that you're spreading out your wealth, so you're not like losing all your money in one thing. And it goes to the old saying, don't put all your eggs in one basket. It definitely applies to stocks. So it's a good idea to at least have like a few picked out. And now I'm taking questions. Anything? I can go back to any slide or. All right then. Thanks for joining me, guys.